ladies and gentlemen. It's a modern investing on Pod TV. My name is Sasha Star, and we have our great guests, Dr. Milan Sombrak. Welcome to the show.
Delighted to be here, and I want you to know I just did something useful. I turned off my phone.
Great. I was about to call you, but now I can't, I guess. And we have Jim Eat from Eat Foundations. Welcome to the show.
Hi, Sasha. Thanks for having me. I appreciate it.
Great to have you. So, we just had a little talk before the opening of the show, and I've just mentioned that last week, on Wednesday last week, I made a call on Palo Alto Network, and that stock did spectacular reporting, went up overnight 11.25%, and then even higher than that. And today is another my favorite stock, and probably the favorite stock of the year, by the way. It gained more than anything in this universe. The name of the stock is, guess what? NVIDIA. Okay. So it's reporting today after the market. And guess what? I've sold 2/3 of my position just today. I'll tell you why. Because when too many people are saying the same things over and over, and the expectations are astronomical, really. I mean, they're all reports, they're always exceeding expectations. Now, this time, the expectations are such to exceed them. I'm not saying it's impossible. That's the only reason why I still keep 1/3 of my position. And maybe I'm wrong. Maybe they will jump today to $700 a share. What a shame. But, there's a common sense that tells me that they could, they have to exceed all expectations on all parameters: the net profit, the bottom line, the top line, the percentage and sales increase. And you can't believe. Now, if on one of these parameters they will not perform as expected, the analysts will say, yeah, they had a good report, but look at this, and here they underperformed and so on, and the stock will go tomorrow down 10% easily. Is it possible? Of course. And as I said before, I'm not going to give so easily my gains of the last several months to the market. It's not going to be easy. I will protect my gains the best I can, even at the cost of losing some of my potential profits on NVIDIA. I still have 1/3, so I still will benefit if NVIDIA indeed will perform so well. But also, because of the cash available, I did something funny. I sold this Friday expiration 400 puts on NVIDIA. I sold quite a few of them. So I think that even if they will go down from 465, they will have to go 15% almost overnight to get me into danger of being exercised. But even that I don't mind, because I will end up with a stock which will cost me less than $400 a share. Okay, I don't mind, because in the long run, as I said many times before, it's a $500 stock or higher. So to own few hundred shares at 400, I have no problem with that. So we'll see how it will be all played. Jim, how you could play this?
Yeah, Sasha, it's so funny that you mentioned selling it. You and I have been pitching this stock for a while, not because we get any financial gain if somebody else buys it, but because we've both been seeing the upside. But I sold. I don't own any NVIDIA now. I sold this week because precisely for what you're saying, all the good news is in, and I just don't see how they can meet the elevated expectations in the future. And I might be wrong, but what I have done, what I did was when I doubled my money, I sold half, and then I just sold the remaining half. Um, on their news, the earnings were going to be great, and everybody was really excited. And so I told myself, enough is enough. I'm not going to get greedy here and try to make a tremendous amount of money. I'm going to lock in the amount of money that I have because it's until I sell, it's paper gains. And now it's sitting in my account as cash, which is very different from owning a stock, which might go up or down. And so and I'm also generally cautious when we get into the September, October timeframe.
That's another consideration.
Yeah,
Yes.
so I'm not a buyer. I'm tend to be a seller right before this kind of, because over time we see market gets fearful around these months, and so I'll start to perk up again in November, December, and I might be become a buyer again. But right now I'm a little bit skeptical. I think that there's more chances of bad news than good news in NVIDIA's future. And I hope for NVIDIA investors that they're wrong. But I think the AI upswing and all the excitement about the AI, and NVIDIA is wonderfully well positioned, as we've been saying for a long time now, to take advantage of that. But I think that there are major players that are getting into that sphere now that have resources, unfathomable resources to throw at this. And so the earnings may not be as bright in the future because competition will increase.
But Jim, you underestimated the NVIDIA's resources. They are cash rich.
No, I know. I think NVIDIA is not going to go under or is in any danger. I just don't think that they're going to be the sole, the obvious play in the future that they are now.
So far they're so much ahead of everybody. Not that nobody can catch them, but so far they're enormously ahead. And the company is well executing over and over and over campaign.
So maybe I got out too soon, but I'm happy with
no. I think you're right. I'm working on a model now to get at least once a month to get into 100% cash position. It's for me, it's not easy to do simply because I have a lot of synthetic positions when you have either a covered call situation, so you need to close both positions. Actually, another beauty of my strategy is that you've heard about day trading. It's
sure.
Yeah, everybody's saying how
that was all the rage a while ago.
But the beauty of this position, what I'm describing, like covered call, for example. Let's see the like lately, several days that the market opens down and then recovers or so. So the moment it goes down in the first, say, half an hour or so. So obviously your sold covered calls, you can buy it back at much lower prices. Let's say you sold covered call, you got $20. Now you sold, say, 5 calls, and then stock opens down or so on. So the calls are going down to, say, $17, even $16. So you buy them back at that time, and then same day or maybe next day, you will sell them again, and maybe even at higher price than you sold originally. So you're making a little bit of money on closing the position, and your opening position a few hours later, a day later, maybe even 2 days later, it doesn't matter. You're already sitting on the house money a little bit, just a tiny bit, but it's beauty, it's green. Your cash position is good, and then you sell it again. So there are elements of, and it's not very risky proposition anyway, because obviously you're dealing with a stock, with underlying security, which you believe a lot, it has potential. That's why you choose so. And to be on protective side, you sold some covered calls. By the way, remember I recommended last Wednesday strategy of selling deep into the money covered calls. So let's say the stock is $400 and you're selling, say, 350 covered call. Now, I figured out that as long as the stock will not go to lower than, say, 320 or even 310, which is 20%, very severe correction and almost in one day, which is not happening very often.
No.
Other than that, you are making money guaranteed. Just one exception, it's a severe one day 20% or more correction on that particular stock. Are there chances that it's going to happen? Yeah, there are. Okay, so
But you like the odds.
I like the odds, exactly. So it's same thing. Let's see, I sold cash covered puts today. I sold them yesterday though on NVIDIA. This coming Friday expiration, the price is $400. I didn't get a lot of money for this. I sold a lot of positions, but they're trading now, say, I think $4. Actually, $4 in 2 days. So if you sell, say, 10, maybe 20 of those puts, and it's almost free money, it's a house money. House brings you the money. They ask you, you want to deposit on your account or you want to get certified check? Get a credit card payment. So, I just figured out, okay, if I'm not going to do it, somebody else will do it. So somebody else will get this money, not me. That's not fair.
I want to let Milan, I have one more comment to make, but I want Milan to be able to chip in here. And,
absolutely.
Yeah. So, Milan, what do you think about what Sasha and I were talking about just then? I know you're not an advocate of individual stocks.
It's obvious that both of you love, and it's important for you to be involved to a significant extent. You know, the Monday Morning Millionaire members are primarily professional people whose main income comes from what they're doing, their work. And so they don't have the time to spend on investment issues that you do. So what I recommend actually works very well. And before I go ahead with that, I want to ask you, Sasha, why,
yes,
when you get deep into the money, the deeper into the money you get, the smaller the open interest, the fewer people are involved. Why is that?
It's a good question. Obviously, this, for example, even this puts that I sold, which I described just a minute ago, there is very thin volume there too, because you see, you know the mechanics of trading options. There are market makers who have to make the market if there are no outside interest, for example. So when the NVIDIA is, say, 460, on 460 calls and pulls, on 450, 470, there are millions of bids and asks and all people trying to buy the market and so on. Now, the thinner it's becoming when you are going farther away from the stock price, or when you're going to 430, it's much thinner volume. 410, even more, and 400, there is a market maker. So you're basically, you're using actually your position that, okay, you can buy, you can sell, you can stay away from it, it's up to you. The market maker, on the other hand, he must provide an auction to somebody who wants to trade, buy or sell or whatever. So I'm using market maker on NVIDIA, on options, to provide me with some kind of a bid that I will be satisfied with. Yeah, there's more difference between bid and ask, so the spread is wider. But I don't care because this money will end up in my pockets anyway. So, okay, so I will get $25, $30 less than I would in more liquid markets. But in more liquid markets, there is more risk as well. Now, in this market, there is a risk only for a market maker to tell you the
But
truth.
Sasha, wouldn't the market maker also be making the market for someone taking the opposite position from you?
Oh, of
So,
course, yes.
yeah,
Oh,
so he doesn't care.
but on such out of the money positions, where is the other side? How many people beside me in all the world would think about selling 400 puts?
All right.
I know a friend of mine. He is trading options on buy. It's a Simple Gold. It's Canadian company, but well-known gold company. And sometimes he's selling covered calls on Barrick most of the times. And sometimes he is the only one who has sold so many calls. So sometimes he sells 100 calls, covered calls, of course, 200. And he's the only one who holds this position, nobody else. So he is now against the market maker. But his risk is calculated because he has shares of Barrick Gold and he
Right.
sold covered calls. So he is okay in either case. Now, the poor market maker who is obliged by Toronto Stock Exchange to provide market on calls on Barrick Golds, so he has to buy these calls with almost guaranteed negative results. So he will have make eventually his money on some other calls in Barrick close to the money or so on. But these calls he's gonna lose. But he paid the money to acquire the seed on the options exchange. So
Ah,
he's obliged.
ah,
Okay, can I now be specific and say the most important thing that I've ever said on this program directly? Indirectly, I've been talking about this, but it is possible to earn 16.5% annually safely by doing the following. First of all, you have to own SPY, which represents the S&P 500, which represents the American economy, the strongest economy in the last couple of 100 years. So you own SPY, you write covered calls just out of the money on a Monday, expiry date on a Friday, and you get the highest guaranteed premium income just out of the money. Now, if you're assigned and your stock is called away from you at the strike price, now you're in cash. This puts you in a position to write cash covered puts, to sell cash covered puts just in the money. And you can keep on doing that until SPY is put to you again. Now you own it again, allowing you to write covered calls. And if you do that on a Monday, expiry date on a Friday, repeatedly, you will make 16.5% annually, effortlessly and safely.
that's
And
not, hey, that's pretty good.
it doesn't get any better. Do you need any more than that? Now, if you're enjoying picking stocks, let me quote David Svensson, who ran the Yale endowment, by far the most successful university endowment, not as large as Harvard's, but grown at a much faster rate than Harvard. He said, security selection and market timing make no material contribution to returns. Listen again, security selection, no material contribution to returns. David Svensson. Yeah, so there's a man like that talking about it. Now, he also said when you look at the result on an after tax basis over a reasonably long period of time, there is almost no chance that you're going to end up beating SPY. Almost no chance that you're going to wind up beating SPY. Now, your market wizards are doing it, but your market wizards are the Mozarts and the Beethovens and the Handels and the Bachs of investing. Exactly. There are very few Mozarts out there. Every music student wishes he were one.
I'm a Larry, I admit it.
Regardless of how hard a music student practices, the vast majority of them will not be Mozart, Bach, Beethoven, because you need talent that God gives you, if you want to say it. Speaking as an atheist, God gives you this talent, and then you work on it and polish it to become a Mozart, Bach, Beethoven. I have a friend who was the concertmaster of 3 major orchestras by age 25.
Wow.
And he said, I can't ride a bicycle, I can't swim, I can't play tennis, I can't do anything else but play the violin at a very high level. So they pay a very high price. So this business of owning SPY, first of all, and today that'll cost you roughly $45,000 given the price range of SPY. 100 shares of SPY, right cover calls, just out of the money, guaranteed premium income, expiry date Friday of the same week. When it's called away from you, your assigned called away from you, you're in cash. Puts you in a position to write cash covered puts on SPY. And you keep on doing that until the stock is put to you. Then you own it again. You go back and forth like that all along, and you'll be making over 16% annually.
Jim, would you like to respond?
Sorry?
Oh,
Would you like to respond?
I think that is exceptionally good advice for the majority of people, and the people such as Sasha and myself, what we get a lot of this is just sheer fun, enjoyment, and it's also putting our minds against the market's minds. And there's the competition, the competitive aspect of it that I find intriguing. And it may be a flaw in my character, but I like to compete and win. And I have a successful track record of doing this. So I'm no Mozart, and I stick to what I know. I don't engage in things that I have no knowledge of. And so I remain pretty self-contained in what I do, and so I'm very disciplined in what I do too. It's like with NVIDIA, when I get to a certain point, I'm selling, and then I have made my money back plus whatever taxes I'm going to pay, and I still own some NVIDIA, so I still have rooting interest in it going up. And then when it goes up to another point, and I start to think, okay, it's time to get out. And so I did that. So this is my discipline. And I believe, like what Milan is suggesting, the majority of people should pay attention and listen to what he's saying. And maybe follow his advice. It depends on the individual. For someone like myself, I've got to be disciplined. I don't get emotionally attached to any stocks. And I follow the rules that I have set for myself. And this is another way to be successful in the market. And the thing that I have found, like, for example, what I'm wrestling with right now is everything I'm reading now is everything is going back in favor of gold. And we've talked about gold on the show multiple times. And I've always used it as a hedge. If everything else is going down, gold is going to go up. So you kind of buy gold and hope it goes down. It's like, because that means the rest of your market is going up. And the idea, though, is that interest rates and bonds in particular are paying really interesting or fairly attractive interest rates now. They're paying out. So
Right.
Bonds have suddenly become attractive. And that's put a pall on the investment market, investors in general. And so now people are saying, where's the safe haven? Gold. And I'm trying not to get emotionally involved, and I'm trying not to buy into that. Even though all the pundits may be telling me this is the way to go, I'm saying that I've got some gold just in case of disaster. Gold will go up, and I'm sticking to that. And I don't care how many pundits come and tell me, gold's the next best thing.
I always, from time to time, I'm putting some gold element in my portfolio for the same reasons what you do. The only thing is, maybe I'm lacking discipline or so, but when I see that this security is not moving anywhere, it's about the same. The calls premiums are very, very low, even lower than S&P 500. I'm getting I'm getting frustrated because it still eats certain portion of your portfolio. Let's
True.
see, a fund portfolio, so you dedicated even 2% to gold or so on, and then you need this 2% to get some other positions or so on. And I liquidate these positions, no regrets. And well, maybe I will look at it, but right now I don't have any
You
book.
know that gold, a given weight of gold, 5,000 years ago when currency was first introduced, a given weight of gold 5,000 years ago
Yeah.
would buy the same amount of barley that it buys today. Same amount of anything. In other words,
Isn't that amazing?
it
It's
retains
real amazing.
power, which is valuable. The fact that it fluctuates a great deal makes it possible for people who time it right, who have some luck, to make a great deal of money, while others lose a great deal of money. But if you simply hold it for its purchasing power, which is steady over 5,000 years, it's a useful feature to have for sure.
Hey, Sasha, Jim, and Milan, just really quickly as y'all were talking, and earlier I heard a dog barking and everything, and I'm thinking that I've been hearing some great advice from all three of you, and y'all give great and amazing advice. But I do know that there are people out there that literally will follow what their astrology tells them, or sometimes even what their dog tells them. So I was just wondering if you could speak to those folks that are doing some very crazy kind of marketing, because they are even sometimes listening to non-experts, because I would consider all three of you to be experts in the notion of investments, and y'all are students of investments. But I sometimes hear people that do the what I call the fantasy football way of doing things, which is that they look at the investments and they're like, "Hey, it's got the right color, it's got the right logo. I'm going to invest
Team
in it."
mascot's
All
good.
in that space. So I was just wondering, Jim, you got any thoughts about that? Because I do know people that literally will look at a logo and be like, "That look, I like Tony the Tiger. He's a good he's a good mascot. Therefore, I'm going to invest in that space."
You know that we can teach a high school student how to equal the market in less than 15 minutes. And people who you just described, I hope they're having a lot of fun, but they trail the market by 40%. If you can have fun trailing the market by 40%, I envy you, because I couldn't do it.
Milan, do you personally know people who are trading the market by 40%?
Well, very few of them will tell you that they're trading the market. Yeah. You know, the cocktail parties, nobody talks about how much money they lost. I do.
I do too, yes.
I wish one day I will see the actual face of a person who is trading market by 40%. So I would take a look. What kind of face is that? What kind of person is that? How is it possible? Because if you will ask me to lose 40% of the market, I would struggle to find how to do it.
Well, Sasha, if you looked in the brokerage industry in the 70s and 80s, you find so many examples of people that have lost everything.
Yeah.
Yeah,
But
there's
Jim,
so many
not only
tragedies
that,
out there.
Jim, not only that, but there are people that literally, in the sense that y'all are talking about, are having a certain amount of money that they feel that they are comfortable losing. I know people literally,
Yeah.
even in my own family, that will go to the casino and know how much money they will take to the casino and how much money they are willing to lose. And in some cases, including some family members, they have won a significant amount and all that. And even with the lottery, there have been people that know how much money they are willing to lose in the lottery, and some of them have a substantial amount of money that they're willing to invest. I know some people that might drop $5, $10, $15, maybe even $100 a day, and sometimes they can't always afford it, but they have designated that kind of money, what y'all call fun money. They have designated that it's their fun money, but sometimes it is less fun than it actually is.
Every one of us would love to live in a country where we pay no income taxes and yet maintain a high living standard. And Monaco is such an example. People who live in Monaco, or Monégasque they're called, pay no income taxes. All the earnings come from the casino, where Monaco people are not allowed to go in except to work. And so that's what happens with gambling, because Monaco is benefiting from that. Now, Singapore recently, a couple of years ago, opened two casinos, And if you're a Singapore resident, you have to pay $100 just to go through the door. If you're a tourist, you're welcome to go through the door.
And Jim, correct me if I'm wrong, but I think that there are some states, even in North America, that have similar kind of rules where they try to not have the people that are living in those states working there. But one of the things that happens in that space is that sometimes people are seeing the money go out, because I know that there are 2 new casinos in Virginia. I'm in North Carolina, and there's actually our legislators that are thinking about bringing some casinos outside of the Indian casinos, because there is an Indian casino in North Carolina, into the area, including some major cities, because they're, from their standpoint, they're going like, hey, this money is going out of my state. Why don't I let it stay in my state if the people are going to be investing anyway?
Well, speaking about casino, I'll tell you one thing. Of course, your chances to win on the stock market are much greater than in casino, because you can play calculated game using certain strategies or so on. In casino, the best game where you have most chances are blackjack, where you have, if you play the right strategies, the basic rules, your chances are 48.5%. That's pretty good. Actually, I'll go even farther. If you use strategy when you stay on 12 and higher, so if you have 11, you take card, you have 12 or higher, you don't take the card. Your percentage is still 40%. So if you don't know what's happening and you're playing, for example, this kind of a game, let's see, the dealer didn't go bust for 5, 6, 7 hands in a row. It means the bust is coming, because on average it's 1 out of 4. So if 5, 6, 7 hands,
So you're betting up.
so all I'm doing, of course, I'm betting now up. I'm not taking card on 12. It's only unpleasant. I was playing in Las Vegas, and I was playing that strategy at that particular time, and I had 12, and dealer had picture, and I didn't take a card, and all table was furious at me. How dare you are? You have to play for a table. And I told them, no, you play for a table. I'm playing for my pocket. Thank you. Okay, they got quiet, and he was busted right on that particular time. He was busted. So I was playing a lot blackjack in Moscow, where I was doing consulting work. It was back 2007, 2008, and 2009. They completely stopped all casinos. However, by that time, I was allowed to play only in one casino. Most of the time, they had probably well over 10 different casinos. Some of them were quite large. And I was allowed to play only in one. And the way it was explained to me, one manager of one casino, which unfortunately stopped me from playing there, he told me, he was an Englishman, and he told me, look, you don't count the card. You're playing a fair game. But he says the problem with you is you're winning most of the times, and it's not that you're not winning a lot of money. You're winning $3,000-$5,000. That's okay. But we have other people who are winning $50,000 and $100,000, but they're coming next day and leaving $200,000. Now you're coming next day and you're taking out $1,500. Next day, $3,000. I don't see a scenario how you will come and leave some money. So therefore, it's unprofitable for us to patronize you. Mm-hmm. Plus, you are coming, you have a gourmet dinner, drinks, you're bringing friends, or so on. So it's, I asked, do you think I'm playing a fair game? I'm not counting the cards, and so on. He said, okay, you know what? Let's try for 1 week. You will play a blackjack, but only with the shuffle machine, not against live dealer dealing the cards, but shuffle machine. Okay, I played for 1 week in shuffle machine, and that was the end. Because same thing happening. What I was using, the same money management technique, but I'm using on stocks. I'm playing the basic strategy, of course, and I'm playing. Let's see, if I start with say $2,500, I can allow myself to lose, but no more than $250, 10% from my um,
Starting
total amount, starting amount. Now, once I lose 10% out, you can go to another table, another casino. You have to interrupt the process. That process has to be interrupted. The same thing when you have a stock and goes down 7, 10%. You sell it. You have to interrupt the bleeding. Now, let's see, I continue to play. Now I'm doing so okay. So my starting amount increased to $3,000 instead of 25. So now you're not allowed to lose more than $300, which is 10% from your maximum. So you always have to know how much money you have in game. So you got 3,000, you lost 10% out. You're still $200 ahead, but you interrupted the bleeding process. You're going to another table, or just go for just to have some air, just to relax. I remember many years ago I was in Atlantic City on a day trip, and I started with $2,500. I lost 250, stopped the playing, so went to another table, started to win, get to 3,000, lost 300, stopped the game. But you see, the process was quite difficult. I was not definitely lucky the day, so it was really a hard fight. So eventually, it was still 3 hours before the flight back. I was already up 4,600. So 25 plus I won 2,100. And I started to think. My goal was to double my money. So my goal was to win, to have $5,000.
It's always my goal.
Now, I have 4,600. And I went on a boardwalk just to get some fresh air. And I started saying, oh my God, I'm doing okay. I'm winning. But the game isn't easy today. It's a huge fight. And I started to think, why am I so greedy? If I already have 46, which is 21, why don't I stop, have nice dinner, get a flight, fly back? And that's what I've decided to do. Now, on the way back to the casino, I started to think, though, what if I just came from Toronto with $4,600 of my own money, and all I need is to win $400? That's all I know. Oh my God, when I thought about it, I didn't walk. I ran to the casino and then jumped at the first available table, made $900 in a matter of a minute and a half, got out, make myself a certified check for $5,000, and bought some presents for the rest of the money. So that was the funniest thing. So it all depends on your psychological settings, the attitude, and so on. So
I was just about to commend you on your personal growth with walking away. And then you spoiled it by going back.
I spoiled it big time.
Yeah, well, a lot of people have that. I know that I have family members that have a designated amount, and if they hit that amount, then they bounce, and they have definitely won some money. Sometimes, even if you win money, you sometimes get the other folks that will get you back and everything. Because I know that I had one relative that won some decent amount of money. I think they won like about $1,000, and they just recently got a call that the speed folks that follow your speedometer had caught them speeding when they were coming back home, even though they claimed that they weren't speeding. So, like I said, they were thinking that they were going under the speed limit. But hey, maybe the state knew that they had won money and figured that they were going to get their at least 100 or part of that back, because it's not going to be worth it to fight it, because the lawyer is going to cost more than it is going to cost to pay the ticket.
Yeah.
Interesting twist, yeah.
Sasha, you were making a comparison between stocks and being in a casino, and when a security drops 7%, you sell it. Now that's against the philosophy of dollar cost averaging, and dollar cost averaging works all the time. One of the few ways of beating the market. Another one, just as an aside, I'll say that when a company is buying back its own stock because it cannot find anything useful to do with its cash, that will make the company grow. So they start buying back their own stock. The shares of that stock company go up. The value doesn't, but the price does. Value is quantifiable and it's logical. It's the company's
Yeah.
asset from
I
which you
agree with that.
subtract the company's debts, and that's its true value. But its price fluctuates a great deal, and so you can take advantage of those fluctuations by dollar cost averaging. And you're against that. When the stock drops 7%, you're out of it. You should be buying more.
No.
In-
You see, the problem, first of all, examples that you just told us about has nothing to do with the dollar cost average. With the company buying its own shares, it's
Yeah.
not $2 average. Sometimes they're
Okay.
buying their
yeah,
shares
oh,
on
yeah.
the way up as well. And
No,
in
no.
fact, I believe in cost dollar averaging to buy more stock on the way up, because then you're sitting on a very well performing stock, which you are already in plus. So you're augmenting your position on a winning stock.
You're talking about momentum. You're talking about momentum investing here.
No, I'm talking about the investing principles. When you are building up your position, for example, I'm building now a position on advanced micro devices. Okay, it went down and keeps down. It's making a base. I'm not sure when it's going to go higher. Maybe even tomorrow, if Nvidia will have a positive report. I'm pretty sure that AMD will go higher tomorrow. But the risk today on AMD, in my opinion, lesser than on Nvidia, because Nvidia is everybody expecting so much.
Yeah.
I will I will take off my hat if Nvidia will exceed all expectation on all parameters and will jump up another
I'll
25.
congratulate everyone. That
I will say it's amazing. This is see, Nvidia is already by far the best performing stock of all markets and all over the world. Went up 200% this year alone, maybe more than 200. So this is why, with all due respect, with S&P 500 strategy, when they have Nvidia, yes, it's part of 500. But there are also 499 stocks, which if I would have Nvidia, I would be there. If I would have only 100 stocks, I would be there. But because I have to have 500 stocks, I'm over there. So it's incomparable. The only thing is, Milan, with all due respect, you cannot compare, for example, the best premium Mercedes 500S with some kind of Chevrolet, middle of the road. One car is driving you from A to B, and the other car is driving you from A.
You can't compare it to a Yugo.
But
leading technology, super corporation technology.
Essentially, if I'm convinced in your strategy, and I'm will dial on my screen S&P 500, and next I see Nvidia, and I can't figure out what there should be in a world which make me to press S&P 500 and not to press Nvidia button. It has to be some kind of absolutely astronomical force.
As I said before, I think you're both right. You have different approaches,
Absolutely.
and you're both disciplined about your approaches. And
Yeah.
this is the main thing that I wanted to take away is the sense of discipline. Because when you get into gambling and casinos, emotions can take you away, and you can get excited or despondent. And these are the things you have to guard against. Like Sasha was talking about, is playing blackjack and just following a particular strategy. And if it came down to he was losing a certain amount, he changed the tables. He changed the situation that he was in. So whatever it is, I don't particularly care too much what it is. There's some things that are more attractive that I listen to than others. But as long as you're disciplined about it and not riding emotional waves, and people are saying, oh, this stock in particular, you have to own it. That's a red flag to me. It's like, I don't want that stock. Sasha just mentioned AMD. I own more AMD than I want to. But, these are the types of things that you just have to be disciplined. you know, and check your allocation, your stock allocation. If it, all of a sudden you have 75% cash and 25% stock, well, maybe it's time to move into more into stocks. You know, if you have it the other way around, maybe it's time to get in more into cash. That's kind of a discipline that I have. Otherwise, you know, what you're doing is just you're just not asserting any kind of your own powers of discretion and observation and experience in your letting the market play with you.
I don't know how the market wizards feel about asset allocation, but people like David Svensson and now Berkshire Hathaway, Warren Buffett, and people of that stature all feel that asset allocation is more responsible to decent portfolio returns than picking stocks is, or market timing.
I've always believed that. I've never studied the results to give you any kind of scientific data on that, but I've always sensed that, and I've also always believed in dollar cost averaging as long as the company is good. You know, I've made a lot of money dollar cost averaging on the way down on good solid stocks that were getting hammered in the press.
Good for you, Jim. You're right about that, about dollar cost averaging. You could pick the wrong stock, and as it drops down, you're buying more of a losing situation, like Nortel here.
Right. Enron, you know, there are examples. Yes. Yeah.
Of course.
No, let me tell you something. It's not an wrong story. I know this. The problem is that when stock drops down, and there are heavy cross currents involved. It's not just fundamentally company change or competitor appears or so on.
Right.
It's just a technical picture is deteriorates, even if it's not dropping like 50% or 75%. No, forget about that. It just drops, say, 15, 20%. Then what's happened next? It's not going to go like V-shape correction. No, it's going to have to go all the way down, stay there, so all the losers will unload their stocks and take their losses, and only then 2-3 months later, after building the base, then it could start to recover. So the problem is with all this dollar average on the way down, you are taking your good money out of the market and they're sitting in a losing position for considerable amount of time.
That's where we differ, Sasha. You're saying 2 to 3 months is a considerable amount of time.
Yeah.
And to me, it is not. And that's the difference in our approach. And both approaches are valid, because what works for me is waiting out that 2 and 3 months. And then that curve that was going down like this goes back up. I'll give you one example. IBM.
Most likely, yeah.
IBM was a great company, a solid company, let's put it that way. And it got some bad news, and everybody started. It went down below its blue book value, and I was thinking, I'm buying now. And I started to buy, and it went down more, and I bought more. It went down more, and I bought more. And then, you know, it took about 2-3 months, but then it went back to where it was. And it dropped about 50%, Sasha.
But Jim, wouldn't it be wiser for you to start buying it when it started to go up, and then you're coming with my dollar averaging?
Yes, but basically, I would have invested about the same amount of money, because I was buying at the low point, not at the very low. So when it started to come up, at that point where you're buying, I already own.
The difference is that you were sitting there for 3 months.
That's right. I was sitting there on that money for 2 to 3 months. And
another thing is there was a damage done to your psyche, is that you were seeing red on your screen. So the problem is that I cannot tolerate seeing red.
You see, I had ultimate confidence in my opinion that this was a good stock. I did not mind it being red for a little while, because I knew it was going to be green.
Good for you, Jim. Good for you. Yeah. Now, the issue here is you're talking about individual stocks, but let me ask you, where will the American market be 5 years from now? Up or down? What do you think?
I think it will be higher.
Yeah, of course. And 10 years from now, it'll be higher, probably even in 4 and 3 years, but in the future, it will be higher. So instead of picking individual stocks, if we select the American economy as a whole, as represented by SPY, which tracks the S&P 500, So we are now betting on the American economy, the most successful economy in the last 200 years. It will recover, so that when we are dollar cost averaging the American economy instead of an individual stock, we are buying more when it is a bargain. Dollar cost averaging requires us to use the same amount of money using the same security during the same time intervals. If that security is SPY, the same amount of money buys less of it when it's expensive and buys more of it when it is inexpensive. You come out ahead, guaranteed. Very few ways to beat the market, and this is one of them. The other one that I mentioned is to beat the market when a company is buying back its own stock because it can't find anything useful to do with its cash.
Yeah,
Then
which is always
the
amazing.
price will go up. The price will go up. The price is variable a great deal. The value isn't. The value, which is of a company, which is its assets minus its liabilities, that value is always there. The price fluctuates a great deal.
Well, when the stocks, when a company doesn't know what else to do besides buy back its own stock, it's also rewarding its CEO and all these other people.
Oh, for sure.
A great deal. And the thing is the old economic theories were saying, well, they will use that money to build more factories and employ more people, so it's good.
Yeah,
but that's not what's happening.
Oh,
that hasn't been happening in decades. What's happening is they're buying back their stock. They're rewarding their management.
Exactly, because we think that the corporate executives and investors should have similar interests, but they don't. Investors should see the company grow by investing intelligently in situations that will make the company grow. But if you're buying back your own shares of your own company, that rewards the existing shareholders, primarily the executives, who get a lot more compensation and a lot more value without having done a damn thing.
Of course, they're going to vote to buy back their stock. If they have all that stock, it's going to go up.
Okay, let's imagine a situation that Walmart, who had hundreds of stores in the United States and Canada, and they covered every market nation. They opened just enough stores elsewhere, and they're sitting on billions of dollars. And they can still arguably they could open yet another store, but because it would lead to saturation of the market and they will start competing with their other stores, so that new store may not be profitable, or it will be profitable by eating into profits of other Walmart stores. So maybe it's not prudent strategy to continue build more and more and more stores. So in this case, they're sitting on a few $1 billion cash, and they cannot open new store. They can raise salaries of all their executives and tellers and everybody else. Would that be a good thing for shareholders? Probably not. However, if they will buy back a certain number of shares, doesn't matter at what price. Let's see, they will allocate, say, $2 billion and equal 12 months, say 1 month increments, they will buy certain shares. So obviously the profits per share will be increased because there is less number of shares outstanding, which is good for shareholders. Now they can also increase their dividends as well. So it's usually one or two things. If company is sitting on excessive cash position, normally they choose one of two things. Now, when executives own a large percentage of ownership, they obviously increase their dividends because it benefits the directors and the officers of the company. If not, they will just keep buying their own shares, which is good for all shareholders, most likely. So this is what I wanted to say about buyback. It's, in my opinion, it's a positive thing if the company, or let's see if you take even this horrible company, part of Dow Jones, Steel, Walgreen, Boots. They're paying substantial dividends. Still, even now, their share price went all the way down south. They're still paying about 4.5%. even 5% dividends. Now, the only way how the stock would go higher if the Fed will start go easy on interest rates, and they will go down to 3%, 2%, even 1%. So now 4.5% of Walgreen is becoming quite juicy thing. Same as with all other dividend stocks. Right now, their price is depreciated simply because the bonds or even T-bills, they're offering competitive rates. So it's going to happen sometimes next year, not before.
Sasha, can I say a few things about
Yeah,
Walmart, which
please.
you mentioned? We're all looking for high quality, low price, and good service. And only 2 out of those 3 are possible. And Walmart is going for the low price. Now, many people have never heard of Arkansas, and almost nobody has heard of Bentonville, where Walmart originates 50, 60 years ago. And yet, department stores are all over the place. How is it that a department store, which is a terrible business to be in, does so well that in less than 50, 60 years, for a while, Walmart was the most valuable stock on the planet?
And what happened to Woolworth?
Yeah. So they
JC
go for
Penney.
the low price, and so they have the second largest computer system on the planet, right behind the Pentagon. Pentagon has the largest computer system. Walmart is the second largest.
Wow.
The minute you take anything from Walmart, they know that it needs to be replaced. They also know your purchasing behavior and a whole lot of other things because of the computer system that they have. So
this is also why Amazon is so effective, in my opinion, too.
But Sam Walton was able to see the importance of computers when a lot of knowledgeable people said that computers have very little future, hardly anybody needs one.
Yeah.
And so it's an astounding story based on low price.
Who would need a gig worth of memory on their phones?
Yeah, but don't people need low cost in general? Because another 2 companies that are very popular that use that same low cost model that Walmart used is Costco's and Sam's, because they're in areas that are set of not like in the city cores and all in that space, but people are going to go to that area because they are trying to get the wholesale costs. And I think that that's part of what the Walmart model is as well, as people are trying to find a quality product at a cheap price.
That's right. Now you take a look at a company that was offering service like Bed Bath & Beyond. You go into Bed Bath & Beyond store and you ask for anything. They will lead you to it, and then the individual will tell you what's available and what compares and so on. Yeah, Bed Bath & Beyond closed its doors recently. It's no longer in existence. The service was not as important to most people as the low price is. Yeah.
It's fascinating. And do you think that changes during, in generations and even within one generation? Because I know that, my parents grew up in it was a depression era mindset, and they were not big spenders. And then, people that were baby boomers,
I think the discount model has been in existence for a while now. Sometimes people will get in trouble because they don't have the greatest business acumen, and I will agree with that, because definitely Sears was very successful for a number of years, and it was in that discount model. I personally think that Woolworths got in trouble partially because of the race relations, because Woolworths was also very much involved in civil rights and things along those lines. So that is part of what killed Woolworths, even though it was very much of a discount company as well. But I mean, look at Kmart. So I do think that in general, the American and the world public is looking for something that is going to be discount based. So I think that that's why even dollar stores are very popular as well.
Yeah. The dollar store used to be the nickel and dime store not that long
ago.
Yeah.
The 5 and dime. That's what we used to talk about.
Yeah, okay. I wish there would be a discount on all my favorite stocks. So I would have a magical coupon where, okay, I'm going to say CRM is $210 stock, but I have a coupon, allowing 20% discount. So I put it go. Oh, thank you so much. Great service. I wish we would have something like this. Well, thank you very much for all participating in today's show. we'll see how NVIDIA will play its report today. I'm very curious.
Yeah.
Probably you are as well. And we'll see you next week, same time, same place.
Thank you
Thank
very
you
much.
so much, everybody. Have a successful week of trading.
Bye bye.
Thank you. Thank you. Bye bye.